Good evening, everybody. Sri Ashwini Kumar and friends, a very warm good evening to each one of you. Banking is necessary, but banks are not. I am quoting here Bill Gates when he said this as chairman Microsoft way back in 1994. Today, after 20 odd years, has his prediction or forewarning come true? I intend to explore this in today's discussion with you. It is usual for many of us who lecture others to say, we are at crossroads, the paradigm shifts that are staring at us, etc. That's because it takes time to discern the trends that are taking place in any sector, and unless we take a pause to look carefully, the emerging patterns are easy to be missed at great cost to many stakeholders. And when we do pause and observe, we can't but say we are at crossroads, the paradigm shifts that are staring us, etc. In a PwC report in July 2014 on the future shape of banking, time for reformation of banking and banks, they said that at the macro level, they had identified 5 global megatrends whose impacts, intersections, and collisions are reshaping the business of banking world over. While these all are relevant, they pointed out that the most influential of the trends to be the demographic and social change, creating new customer demands and shareholders' expectations, and technological breakthroughs changing everything from customer relationship to business models. A Willis research report published in Resilience in April 2015 said that the financial institutions industry, including banks, asset managers, and financial technology companies, is currently faced with a paradigm shift caused by a number of key megatrends. It identified the regulatory capital requirements, digitization, and technological advances, new market participant, demographic and behavioral changes in the new generation of customers as some of these trends. Another report, a report on connecting the dots of the new paradigm shift in banking by Scope Ratings, said in June 2016, looking at the current trends, we view the crossroads for banks being laid rather precariously at the intersection of these 3 powerful trends, winds of change. They are technology, regulations, and macro developments. So what is common among all these research reports? It is the emerging trends in technology, regulatory changes, and consumer behavior and expectations, which are redefining banking and banks' role and even endangering banks' existence. What do I say? Redefining banks' existence. That's because, as the reports put it, if the banks were to not take full account of these trends and developments, they would risk emerging from the financial crisis recapitalized, restructured, reformed, but irrelevant. That's a powerful statement, in my opinion. So the 3 trends are the technology, consumers, and regulation. Let us see each one by turn. Technology. Channels, fintechs, apps, social media are the buzzwords. Technological developments are changing the way the banks and their customers interact. These developments have created opportunities for new entrants, not necessarily new banks, to disrupt traditional business models and penetrate new markets. The plethora of technological products and services, such as the World Wide Web, mobile phones, and apps, have helped the emergence of fintech companies who offer lower cost services for traditional services such as e-payments and online trading, etc. Social media companies such as Facebook, Twitter, and Google have a huge customer following and are entering into the financial sector, bringing new sources of competition. Consumers. Millennials, instant gratification, no loyalty, these are the buzzwords. There is a new generation of young people known as the millennials. They have different expectations and their ways of interacting with banks are also different. They prefer not to come to banks for banking services. Rather, they would prefer to avail the services through online and social media-based platforms. If millennials behave this way, what about the mature customers, the older and retired? They are demanding improved returns from investments and demand greater transparency. Regulation. What are the buzzwords? Standards, consumer protection, ring fencing, capital. Since the financial crisis, regulatory emphasis have focused more on capital. This has led many banks to divest themselves of risky or capital-intensive assets, businesses, and even markets. This has also brought a sea change in bankers' attitude towards risk and clearly marked the boundary between retail and wholesale banking. Banks have also been investing and recruiting heavily in compliance to meet new regulatory requirements. Another offshoot of the stricter enforcement of regulations is the increasing business and growth of non-banking financial institutions, the shadow banks, that are not subject to the same degree of intense regulation as banks. They are offering competing services to bank clients, establishing specific funds, or offering private equity and the like. Thus, you will all readily agree that these three trends have clearly redefined banking. I also said these emerging trends are endangering banks' existence. Am I echoing Bill Gates here? From the time the concept of money was understood, the concepts of lending and borrowing came into existence, but the concept of banking wasn't there. However, the organized way of lending and borrowing happened when the prototypes of modern banks were established some 700 years ago. Banks undertook another service, that is a remittance service, en route. Thus, what the banks did, that is borrowing, lending, and remittances, came to be known as banking. Banking is what a bank does, or banks are those who do banking. Our Banking Regulation Act also says. The mega trends that we discussed have redefined banking and bank sizes, as we understood. Actually, it is not redefinition, in my opinion, but de-definition. Banking is no longer what a bank does. It is also what a non-bank does. Banks are no longer those entities who do banking exclusively. Now others, the non-banks, also do those. Chunking of banking is the norm. And for undertaking each of these chunks, there are some specialized entities who undertake only those chunks. Payment service providers, P2P services, P2B services, consumer retail financing, disintermediation, crowdfunding, open-ended mutual funds, money market mutual funds, deposit alternatives, trade financing, invoice financing, bill discounters, bill collectors, credit referrals, account aggregators, interest-free products, syndicators, investment bankers, MFIs, co-ops, housing finance institutions, and credit raters are some of the entities who chipped away chunk after chunk of banking. Is there an element of banking today that remains the exclusive privilege of banks? Sadly, no. That is why Bill Gates said what he said. Banking is necessary, but not banks. How this happened? Admittedly, it is the technology and the customer expectations which chunked away or which enabled chunking away the different elements of banking. Will banks really cease to exist? That's a moot point. At least, as one of the research reports says, while we are not looking at the end of banking, we are surely looking at the end of banking and banks as we currently know them. The chunking away of banking from the banks have given enormous business and growth for these non-banks. With their specialization and focused service rendering, they are able to offer that chosen service at greater efficiency, speed, and at very affordable cost to the consumers. This has stumbled the growth of banks today and has every potential to lead to degrowth and ultimately even decimation of banks. As we know, unconventional policies are rampant in the world. First, it was low interest, then it was near zero interest, then it was zero interest. People thought that zero is the lower bound and one cannot breach it. Now the lower bound has been breached and there are negative interest. Jurisdiction after jurisdiction is ushering in negative interest rate regime. Is there any lower bound for negative interest? Obviously no. Can banks survive if this trend persists? Another set of questions are about the justification for banks to exist. Why the society should accord the special privilege of banking to banks? That is, why should there be a licensing for undertaking banking activity and giving special status to the banks and prohibiting others from entering into the banking business? Let us recall that the West no longer officially designate anybody as banks. They have only a depository institution or a credit institution. Our FSLRC recommended Indian Financial Code also reflects similar thinking. The other day, Mr. Mohandas Pai asked me, given the non-banks do banking, what is the justification for the banks to impose a cost in the form of net interest margin of 3% or so on the society? What is a special set of services you do? He asked. In what way rendering banking services under one umbrella is relevant any longer? Yet another challenge for the bank's existence is the reaction by the society to the financial crisis, the consumers' distrust in banks. Remember the movement against Wall Street, the Dodd-Frank Act, the Likanen and Vickers reports, the ring fencing of wholesale and retail banking? Faced with the challenge of dramatically decreased consumer trust in post-crisis financial services market, financial institutions are increasingly acknowledging the need for new perspectives and paradigms in financial services. One more onslaught on banks' existence is the net effect of the regulatory requirements on capital and leverage and the market and public expectations on their capability to leverage their capital. Banks, by definition, as we know all these days, are the highly levered institutions. However, if we go by these factors about which I mentioned, that is, the regulatory capital, market and public expectations, we should be dropping the definition of banks being highly levered institutions. If we add the capital requirement as per TLAC prescriptions, bankers' usual cautionary additional capital, yet another add-on as per the public expectation as a fallout of stress test assessments, I am afraid we'll end up with banks having a debt-equity ratio of about 4:1, which is not too different from highly levered corporates. That's one of the reasons why we are very cautious and hesitant about supporting TLAC whole hog. Therefore, the clear prognosis is that either the banks will be dead, or at least the banks of the future are not going to be the banks of yesterdays and today's. What to do? I regret that at the very end of these 2 days deliberations on future of banks, I sound a little pessimistic. I have to paint such a dismal future for your existence as banks. My point is, we have to recognize the realities of the day, the compulsions of the new driving forces that demand a new paradigm in banking and reflect on future course of action. There are hopes, of course. First is to take full advantage of the technological development and enmesh in them to meet the customer expectations. The new consumer is addicted to connectivity, convenience, and freedom. They want not just value-added services, but such services anytime, anywhere, anyhow. Another prescription by some researchers suggests that while banks may have the urgent need to identify new avenues for growth and the need to embrace new information-based technologies, what is of paramount importance is a positive shift towards increased recognition of the social responsibility of the financial service providers. They argue that ultimately, balancing profitability with customer benefit must remain at the heart of any new paradigm. Can you hear some ringing in the bell? The priority sector concept? The much touted, the much despised, the much maligned, and yet rising like phoenix? Maybe yes. But I would think that this time around, it is with a much larger perspective. In financial inclusion, green financing, anti-money laundering efforts, countering financial terrorism, and even in anti-tax avoidance efforts, banks can play a much larger socially relevant role than any of the chunked away entities. One big area you vacated and are let others to occupy by your lackluster attitude is there for your rightful reclaim, if only you make concerted and conscious effort. That is SME financing. Small and medium-sized enterprises are a major yet often overlooked sector by formal financial institutions world over, not just in India. The SMEs reportedly account for more than half of world's gross domestic product and employ almost 2/3 of the global workforce. However, they are the neglected lot, as I said, world over. As reported by the International Financial Corporation, a funding gap of more than $2 trillion exists for small businesses in emerging markets alone. I am not going into the reason for this state of affairs, all of us very well know. In recent years, the fintech companies and the marketplace lending have entered into this vacuum and have become immensely and instantly successful and have become a powerful trend. This trend has the potential to become a game changer for small businesses. Because fintech solutions are efficient and effective, the fintech's disruptive power is at good display. If only the banks can change their current reluctant attitude towards SME financing, they can be a good antidote for these risks and therefore will display their socially relevant role, which in turn can justify their existence for the future. I can only conclude with the idea that if you make yourself socially relevant, not just relevant in economic sense alone, you can have hopes to exist. Thank you for your patient attention.